We're back with another episode in breaking down the One Big Beautiful Bill series. And while most of our attention has been on individual tax cuts and family deductions, there are some notable shifts for tax-exempt organizations and charitable giving. Let's take a closer look at 3 areas that are already getting attention: compensation rules for nonprofits, taxes on university endowments, and the way charitable deductions work for both individuals and corporations. Starting with executive compensation. Under the current tax law, nonprofits face an excess tax when they pay more than $1 million in salaries to certain employees. These covered employees used to be defined as the 5 highest paid workers in an organization. But under the new law, that limitation is removed. Now, any employee who earns over $1 million at a tax-exempt organization may trigger the excess tax regardless of where they rank in the pay scale. Next, the bill restructures the tax on endowments at private colleges and universities. Previously, there was a flat 1.4% tax on investment income at institutions with at least 500 tuition-paying students and more than $5,000 in assets per student. The new rule replaces that flat rate with a 3-level system based on the size of the school's endowment per student. If a school endowment falls between $500,000 and $750,000 per student, the tax remains at a 1.4%. But if the endowment falls between $750,000 and $2 million per student, the tax jumps to 4%. And for institutions with endowments above $2 million per student, the tax rises sharply to 8%. It's also worth noting that this rule now applies only to private institutions with at least 3,000 tuition-paying students, and when calculating an institution's total assets related to the organization, such as foundations or affiliated non-for-profits, are included in the calculation. Now let's turn to charitable contributions. For individuals, the bill brings back a deduction that allows taxpayers who take the standard deduction to also deduct up to $1,000 in charitable donations, or $2,000 per joint filer. This deduction only applies to cash donations made to qualified charities. For those who itemize their deductions, the bill introduces a new hurdle, a 0.5% floor on charitable giving. That means charitable contributions are only deductible once they've exceeded 0.5% of the taxpayer's adjusted gross income. Any charitable contribution that does not meet that threshold in a given year can only be carried forward if the excess surpasses the floor. For corporations, the law introduces a similar rule. Charitable deductions now have a floor of a 1% of taxable income and a maximum deduction limited to 10%. If contributions exceed that 10% cap, the excess can be carried forward for up to 5 years. However, contributions below 1% floor don't carry forward unless they exceed 10% ceiling in a later year. This change could prompt businesses to reconsider how they structure donations and possibly choosing to categorize them as business expenses where possible instead of charitable donations. Some proposals that were part of earlier versions of the legislation didn't make it into the final bill. For example, there's no increase to the tax on net investment income for private foundations. There are also no changes to the unrelated business income, no new rules regarding employee-owned stocks in foundation portfolios. Stay informed because these provisions will likely generate further debate as implementation begins. And as always, if you have any questions, contact Paragon today.